Welcome, everyone, and thank you for joining me today. I truly appreciate you being here. Over the past few months, a quiet but significant shift has been taking place in the global economy. It hasn't been announced with dramatic headlines, and it hasn't triggered a sudden market crash. But if you look closely at investment decisions, corporate strategy, and capital flows, you begin to notice a pattern that's becoming harder to ignore. Foreign capital is becoming more hesitant about the United States. This isn't about one company or one policy decision. It's not about a single trade dispute or one election cycle. What we're seeing instead is a gradual reassessment of risk, reliability, and long-term strategy. And that reassessment is leading many foreign investors and multinational corporations to quietly pull back. At first glance, this may seem counterintuitive. The United States is still the world's largest economy. It has deep financial markets, a strong consumer base, and unparalleled influence over global institutions. So why would foreign capital be reconsidering its exposure? To understand that, we need to look beyond headlines and focus on how investment decisions are actually made. Foreign capital doesn't move based on ideology or loyalty. It moves based on predictability, cost, and long-term returns. And when those fundamentals begin to shift, capital adapts, slowly, cautiously, and often without much public attention. For years, the United States was viewed as the safest destination for global investment. Even during periods of political turbulence, the assumption was that institutions would hold, policies would stabilize, and the business environment would remain fundamentally reliable. That assumption is now being tested. One of the clearest warning signs is the growing hesitation among foreign manufacturers to commit to large, long-term projects in the United States. Building factories, expanding production capacity, and relocating supply chains are not short-term decisions. These investments are planned decades in advance, and they require stable rules, predictable trade relationships, and a clear understanding of future costs. What many companies are encountering instead is uncertainty. Trade policy has become increasingly volatile. Tariffs are imposed, expanded, threatened, or reversed with little warning. Subsidies are offered, then politically contested. Regulations shift depending on administration priorities. And for foreign firms, this creates a planning environment that feels more like a gamble than a strategy. From the perspective of an international investor, uncertainty is often worse than high costs. Higher taxes or stricter regulations can be priced in. Volatility cannot. This is why we're seeing foreign companies delay or cancel projects that once seemed inevitable. It's also why some firms are choosing to expand elsewhere: Mexico, Southeast Asia, Eastern Europe, regions that may offer lower margins but higher predictability. Another critical factor is the growing use of economic policy as a geopolitical weapon. Sanctions, export controls, and financial restrictions have become central tools of U.S. foreign policy. While these measures are often justified on national security grounds, they also carry unintended consequences. When access to the U.S. market or financial system can be restricted suddenly due to geopolitical tensions, foreign firms begin to question how safe their investments truly are. This is especially true for companies based in countries that may not always align perfectly with Washington's priorities. Over time, this has led to a subtle but important shift. Instead of concentrating assets and operations in the United States, foreign firms are diversifying their exposure. They're spreading risk across multiple jurisdictions, reducing dependency on any single market, no matter how large that market may be. Financial flows reflect this shift as well. While U.S. assets still attract enormous demand, the composition of that demand is changing. Short-term financial investments are replacing long-term productive investments. Capital is flowing into treasury bills and liquid assets, not factories, infrastructure, or long-term employment. This distinction matters. Short-term capital can exit just as quickly as it arrives. Long-term investment builds industrial capacity, creates jobs, and anchors economic relationships. When foreign capital prefers liquidity over commitment, it's a sign of declining confidence. There's also the issue of cost. The United States has become a more expensive place to operate. Labor costs are higher, energy prices are volatile, and compliance requirements are increasingly complex. In the past, these costs were justified by market access and stability. Now, that calculation is being reevaluated. At the same time, alternatives are improving. Countries once seen as risky or underdeveloped have spent years strengthening their infrastructure, legal systems, and trade networks. They may not offer the scale of the U.S. market, but they offer something investors increasingly value: consistency. And consistency is becoming scarce. This doesn't mean the United States is collapsing or becoming irrelevant. Far from it. But it does mean that its position as the default destination for global capital is no longer guaranteed. The world is becoming more multipolar, not just politically, but economically and financially as well. Foreign investors are adapting to that reality. They're not making dramatic exits. They're making quiet adjustments, smaller commitments, shorter time horizons, more cautious language in earnings calls and strategic plans. And those subtle changes often matter more than headlines. In the next part, we'll take a closer look at specific examples of how this shift is playing out across industries and why these decisions may have long-term consequences for the U.S. economy itself. To understand how this shift is unfolding in practice, it helps to look at the decisions companies are actually making, rather than the statements they issue publicly. Because while executives are often careful with their words, their investment behavior tells a clearer story. One of the most visible signs is the slowdown in large-scale foreign manufacturing projects in the United States. Over the past few years, several high-profile investments have been delayed, downsized, or quietly abandoned. These decisions are rarely framed as a loss of confidence. Instead, they're explained as strategic reassessments or adjustments to market conditions. But when the same language appears again and again across different industries, it points to something broader. Automakers provide a useful example. For years, foreign car manufacturers viewed the United States as a natural place to expand production. The logic was straightforward. The market is large, demand is strong, and producing locally reduces exposure to currency fluctuations and trade barriers. On paper, the United States looked like a long-term growth opportunity. That logic has changed. Trade tensions have made cost calculations far more uncertain. Tariffs imposed on imported components raise production costs even for vehicles assembled domestically. At the same time, incentives tied to industrial policy come with complex conditions and political risk. A subsidy promised today may be challenged tomorrow. And when investment decisions involve billions of dollars and decades-long timelines, that uncertainty becomes difficult to justify. As a result, some manufacturers are choosing a different path. Instead of expanding U.S. capacity, they're strengthening production in countries that offer easier access to multiple markets, fewer trade disruptions, and more stable policy environments. Mexico, in particular, has emerged as a major beneficiary. It offers proximity to the U.S. consumer market without many of the same political risks, and it allows firms to hedge against future trade shifts. This pattern isn't limited to autos. Technology firms are also reassessing where they place their long-term investments. Semiconductor manufacturing, data centers, and advanced electronics require massive upfront capital and stable regulatory frameworks. While the United States has pushed aggressively to attract these industries, foreign firms remain cautious. Export controls, especially those tied to geopolitical competition, have complicated decision-making. Companies worry that facilities built in the United States could become constrained by future restrictions, limiting their ability to serve global customers. That risk makes alternative locations, places with fewer geopolitical entanglements, more appealing. Financial institutions offer another revealing perspective. Global banks and asset managers still operate extensively in the United States, but many are quietly diversifying their exposure. Capital that once flowed automatically into U.S. assets is now being spread across multiple regions. This isn't a rejection of the U.S. market, but it is a recalibration. Part of this reflects concerns about fiscal sustainability. The United States is running persistent and growing deficits, financed by heavy debt issuance. For now, demand for U.S. government bonds remains strong. But foreign buyers are increasingly sensitive to interest rate volatility, inflation risk, and political dysfunction around budgeting and debt ceilings. When investors begin to question not just returns, but governance itself, behavior changes. Holdings become shorter term, liquidity is prioritized, and long-term commitments are delayed. Energy and infrastructure investment tell a similar story. While the United States remains a major energy producer, regulatory uncertainty has made planning difficult. Shifts in environmental policy, permitting rules, and political priorities create a stop-and-start dynamic that foreign investors find frustrating. Projects are approved, challenged, delayed, or reversed, depending on the political climate. For foreign capital, this unpredictability undermines confidence. Infrastructure investment, by its nature, requires decades of policy continuity. Without that, capital looks elsewhere. What makes this moment particularly important is that these decisions are happening simultaneously across sectors. Manufacturing, finance, technology, and energy are all responding to the same underlying signal: rising uncertainty. And uncertainty has a compounding effect. When fewer factories are built, supply chains remain weaker. When supply chains are weaker, costs rise. When costs rise, competitiveness declines. Over time, this feedback loop erodes the very advantages that once attracted foreign capital in the first place. This doesn't happen overnight. It happens gradually, and that's why it's so easy to miss. Public announcements still emphasize commitment to the U.S. market. Corporate press releases remain optimistic. But behind the scenes, investment committees are making more cautious assumptions. Expected returns are discounted. Risk premiums are increased. Expansion plans are scaled back. Another important factor is the global shift toward regionalization. Companies are no longer optimizing solely for efficiency. They're optimizing for resilience. That means building multiple production hubs closer to end markets and reducing exposure to geopolitical choke points. In that environment, the United States becomes one option among many, not the default choice. For decades, the U.S. benefited from a unique combination of scale, stability, and openness. Today, openness is being selectively constrained, stability is increasingly questioned, and scale alone is no longer enough to compensate. Foreign capital is responding accordingly. In the final part, we'll look at what this means for the U.S. economy going forward, and whether this trend is reversible or already locked in by deeper structural forces. When foreign capital begins to hesitate, the effects don't show up immediately in headlines or market indices. They show up slowly, in missed opportunities, weaker industrial momentum, and a gradual loss of strategic flexibility. This is where the consequences of today's investment decisions become tomorrow's economic reality. One of the most direct impacts is on industrial capacity. Long-term foreign investment has historically played a crucial role in expanding U.S. manufacturing, upgrading infrastructure, and integrating the American economy into global supply chains. When those investments slow, domestic production doesn't automatically fill the gap. The assumption that tariffs or protectionist policies will force companies to localize production inside the United States has proven overly simplistic. In reality, firms often respond by shifting investment elsewhere rather than absorbing higher costs and policy uncertainty. The result is not reshoring, but rerouting. This matters because industrial capacity is not easily rebuilt once it erodes. Factories, skilled labor, supplier networks, and technical expertise take years, sometimes decades, to develop. When investment is delayed or redirected, the long-term effects compound. Employment is another area where the consequences become visible over time. While short-term labor markets may appear resilient, the absence of new, large-scale projects limits job creation in high-value sectors. Instead of generating stable, well-paying industrial jobs, the economy becomes increasingly reliant on services, finance, and consumption-driven growth. That shift may sustain headline employment numbers, but it weakens economic resilience. Service-heavy economies are more vulnerable to shocks, less export-oriented, and often more unequal. Foreign capital, when invested productively, helps counterbalance those vulnerabilities. When it pulls back, the structure of the economy tilts further in one direction. There's also a financial dimension. As long-term investment declines, the U.S. becomes more dependent on short-term capital flows to finance its deficits. This increases sensitivity to interest rate changes, market sentiment, and external shocks. It also gives foreign investors greater leverage, as their willingness to roll over debt becomes increasingly important. At the same time, global alternatives are strengthening. Countries that attract consistent foreign investment build deeper financial markets, stronger currencies, and more diversified economies. Over time, this reduces their dependence on the U.S.-centric system and accelerates the shift toward a more multipolar financial order. For the United States, this creates a strategic dilemma. Policies designed to protect domestic industry and assert geopolitical dominance may, in practice, undermine the very economic foundations that support that dominance. Power in the global system is not just about military strength or political influence. It's about being indispensable to global capital. When foreign investors begin to see the U.S. as optional rather than essential, that leverage weakens. The question, then, is whether this trend can be reversed. In theory, yes. The United States still possesses enormous advantages. Its market size, technological base, legal framework, and innovative capacity remain unmatched in many areas. But restoring confidence would require more than incentives or rhetoric. It would require policy consistency across election cycles, predictable trade relationships, clear and stable regulatory frameworks, and a shift away from using economic tools as instruments of short-term political leverage. Above all, it would require recognizing that capital responds to trust, not pressure. Trust is built slowly and lost easily. And once investors begin to factor political risk into their long-term models, changing those assumptions takes time. What makes this moment particularly significant is that foreign capital is not acting alone. Domestic firms are making similar calculations. U.S. companies themselves are investing more abroad, diversifying supply chains, and hedging against policy volatility at home. That parallel behavior reinforces the broader trend. This isn't a crisis, it's a transition. But transitions shape the future. If the United States continues down a path of unpredictability, foreign capital will continue to adapt, quietly, rationally, and without drama. And by the time the consequences become obvious, reversing them will be far more difficult. The real risk is not that foreign capital leaves entirely, it's that it stops committing, that it remains liquid, cautious, and temporary. Because economies built on short-term flows are less stable, less resilient, and less influential over time. The story unfolding now is not about decline in the dramatic sense, it's about relative change. About a world in which the U.S. remains powerful, but no longer unquestioned. Central, but no longer singular. And foreign capital is simply responding to that reality. Thank you very much for watching. I appreciate you spending your time here. Let me know your thoughts in the comments below. Do you think this shift is temporary, or part of a longer-term realignment in the global economy? If you found this analysis helpful, please like, subscribe, and share. I truly appreciate your support, and I'll see you again very soon. Bye for now.